Watch any market long enough, and you'll see the same pattern repeat endlessly. Prices rise, the crowd rushes in with confidence, and then, like clockwork, the floor drops out beneath them. This isn't random, it's engineered. The composite operator knows exactly how human emotion works and uses it as fuel. Understanding this single psychological trap is the difference between being the hunter and becoming the prey in these markets. For example, when a stock consolidates after a rally, most traders see accumulation and buy eagerly. But Wyckoff taught us to read the language of the tape. Are insiders actually absorbing supply, or are they distributing into public enthusiasm? The amateur sees opportunity, the professional sees desperation being exploited. Let me tell you something I've observed over decades of studying the tape. The greatest enemy of the retail trader isn't the market itself. It's the story he tells himself about the market. You see, human nature craves certainty in an uncertain world. When a man puts his capital at risk, he doesn't want to feel like he's gambling. He wants to feel smart, informed, justified. So what does he do? He seeks confirmation. He finds it everywhere because he's looking for it. I've watched this play out thousands of times. A trader decides a stock is going higher. Suddenly, every uptick validates his genius. Every piece of news becomes bullish. Every chart pattern screams buy. His friends agree. The financial papers seem to support his view. He's built an entire fortress of confirmation around his position. But here's what he doesn't understand: the composite operator, that great mind behind the scenes orchestrating market movements, knows this tendency intimately and exploits it ruthlessly. During the distribution phase, the operator needs someone to sell to. He can't simply dump his accumulated position onto the market. That would collapse prices immediately. No, he must create the illusion of strength. He must give the public exactly what they want to see. So what does he do? He engineers a rally on declining volume, just enough to draw attention. He creates a minor shakeout that looks like a healthy correction, or a bear trap. He ensures the news flow turns positive. The technical patterns appear bullish. Everything the amateur trader looks for to confirm his bias is present, deliberately manufactured. The amateur sees a spring test after consolidation and thinks, accumulation! The smart money is buying! But is supply truly being absorbed? Or is the operator simply testing how much stock he can unload into public demand? The amateur never asks this question because he's already committed emotionally. This is why I've always insisted that traders must cultivate the discipline to seek disconfirmation rather than confirmation. When you're bullish, deliberately search for reasons the market might decline. Study the volume behind the rallies. Is it expanding or contracting? Examine the spread of the price bars. Are they widening with ease or narrowing with effort? The professional operator has no opinion to confirm. He has only one question: what is the actual balance between supply and demand right now? He reads the language of the market objectively, without the colored glasses of hope or fear. I cannot overemphasize this point. The market will show you whatever you wish to see if you approach it with preconceptions. The tape tells the truth, but only to those willing to listen without bias. The amateur builds a case, the professional builds understanding through observation. Master this single principle, the discipline to challenge rather than confirm your beliefs, and you've taken the most important step toward reading markets, as the composite operator does. Rather than becoming his victim, I want to share with you the most expensive lesson a trader ever learns, and many never learn it at all, which is why they eventually leave the market broken. The moment you become emotionally married to a position, you cease to be a trader and become a gambler hoping for rescue. I've seen it happen to the brightest minds. A man conducts thorough analysis, identifies what appears to be a sound opportunity, and enters a position. Everything seems rational at this point. But then something shifts, something subtle yet catastrophic. His money is now at risk. His judgment, his intelligence, his very identity becomes entangled with whether this particular trade succeeds or fails. Now watch what happens. The market begins to move against him. Perhaps just slightly at first. Does he consult the tape to see what supply and demand are actually doing? No. Instead, he consults his feelings. He thinks about how much work he put into this analysis. He remembers how confident he was. He calculates how much he'll lose if he exits now. He begins to hope. Hope? That most expensive word in the speculator's vocabulary. The price action is screaming at him. Volume patterns have changed. The character of the Rileys has weakened. Distribution is evident to anyone willing to see it. But he doesn't see it because he cannot afford to see it. He's committed. He tells himself it's a temporary shakeout. He tells himself the market is irrational. He tells himself anything except the truth. He was wrong, and the market is proving it. Meanwhile, when the position does move in his favor, perhaps recovering to near break-even, what does he do? He exits immediately, relieved to escape with his dignity intact. Or if the trade becomes profitable, he watches it anxiously, afraid of giving back his gains, and exits at the first sign of normal retracement. He cuts his winners short, while letting his losses run indefinitely. This is precisely backward. Now contrast this with how the composite operator approaches the market. He has no emotional connection whatsoever to any individual position. If the market action tells him he's wrong, he exits without hesitation or regret. If he's right, he allows the market to prove it fully before taking profits. He follows one law and one law only, the law of supply and demand as revealed through price and volume. I've trained myself over many years to view each position as a scientific experiment. My hypothesis is either confirmed or refuted by the market's behavior. When refuted, I don't argue with the results. I simply accept them and move on. There's no shame in being wrong. There's only shame in staying wrong. You must develop this same detachment. View your capital as a tool, not as a measure of your worth. View each trade as temporary information gathering, not as a referendum on your intelligence. The market doesn't care about your commitment, your conviction, or your capital needs. It moves according to the balance of supply and demand, operated by those who understand this balance and manipulated against those who trade on emotion. Be the former, never the latter. Of all the principles I've developed through years of tape reading, none is more powerful or more misunderstood by the amateur than the relationship between effort and result. Let me explain this in the simplest terms. Effort is represented by volume. Result is represented by price movement. When you see these two elements in harmony, you're witnessing genuine market action. When you see them in conflict, you're witnessing manipulation, and therein lies the trap that catches nearly every uninformed trader. The amateur sees heavy volume, and his eyes light up. Activity, he thinks. Interest! Movement! This stock is going somewhere! He rushes in, believing volume alone signifies opportunity. This is precisely what the composite operator wants him to believe. But I've learned to ask a different question entirely. What is this volume producing? Picture this scenario. I've witnessed it countless times. A stock rallies to new highs on tremendous volume. Thousands of shares change hands. The tape is active, alive, seemingly vigorous. The amateur interprets this as accumulation, as powerful buying, as the beginning of a major campaign upward. But look closer at the result. Despite all this volume, all this effort, the price advance is minimal. Perhaps the stock closes near its lows for the day. Perhaps it gaps up in the morning only to fade by afternoon. The spread of the price bars narrows even as volume expands. What does this tell the trained observer? It tells him that supply is meeting demand at these levels. It tells him that someone, the composite operator, is unloading stock into public enthusiasm. The volume represents distribution, not accumulation. Despite how bullish it appears on the surface, This is effort without corresponding result, and it's one of the most reliable danger signals the market provides. Now consider the opposite condition, which the amateur equally misreads. A stock declines on heavy volume and he panics. Massive selling, he believes. Everyone's dumping. I must exit immediately. He sells at precisely the wrong moment. But again, examine the result. If tremendous selling pressure produces only a modest price decline, if the stock absorbs all this supply without collapsing, what does that tell you? It tells you that powerful interests are absorbing every share offered. This is accumulation disguised as weakness. I've built my entire methodology around reading these divergences between effort and result. They reveal the true intentions of the composite operator because, unlike price alone or volume alone, the relationship between them cannot be easily disguised. The operator can create price movements. He can generate volume, but he cannot escape the laws of supply and demand. When he's accumulating, he must absorb supply, creating effort without downward result. When he's distributing, he must find buyers, creating effort without upward result. Learn to read this language, and you'll see through every trap the market sets. The amateur counts the volume and guesses. The professional measures the result against the effort and knows. This single principle, properly understood and applied, will save you from more losing trades than any other tool in your arsenal. Master it, and you begin to see the market as it truly is, not as it appears to be. I'm going to tell you something that may seem paradoxical. The market pays the patient man handsomely, while it systematically destroys the man in a hurry. The amateur trader operates in a state of perpetual urgency. He feels he must act now. There's a stock moving. He must catch it before it's too late. There's a rumor circulating. He must position himself immediately. The market opens strong. He cannot afford to miss this opportunity. This frantic energy, this compulsion toward constant action, is perhaps the most reliable path to ruin I've ever observed. Let me explain what actually happens in the market. Every significant move occurs in distinct phases: accumulation, markup, distribution, and markdown. These phases don't unfold in hours or days. They develop over weeks, months, sometimes even years. The composite operator works methodically, deliberately, patiently through each phase because he understands something fundamental. You cannot rush the absorption of supply or the unloading of a position without destroying your own profit potential. But the amateur? He has no patience for these phases. He sees a stock emerging from a consolidation and jumps in immediately, without waiting for confirmation that accumulation is truly complete. Or worse, he buys late in the markup phase when the move is nearly exhausted, simply because the price action has finally become obvious enough to catch his attention. Then, having entered prematurely or belatedly, what does he do? He exits at precisely the wrong moment. I've watched this comedy of errors repeat endlessly. The trader buys a stock during what he believes is accumulation. The stock then does what stocks always do during proper accumulation. It churns, it tests, it shakes, it goes nowhere. Days pass, weeks pass, nothing happens. The amateur grows restless. This stock is dead, he concludes. My capital is trapped here while other opportunities pass me by. So he exits, frustrated and bored, often taking a small loss just to free himself from the psychological burden of the position. Then, sometimes within days of his exit, the stock begins its markup phase. Everything he waited for materializes, but he's no longer positioned to benefit. Why? Because he couldn't endure the necessary preparation period. He demanded immediate gratification from a market that operates on its own timeline, not his. Conversely, when he does catch a profitable move, fear and impatience strike again. The stock retraces normally, a natural part of any healthy advance, and he exits hastily, afraid of giving back his gains. He takes his small profit and watches in agony as the stock continues upward for weeks or months afterward. You see the pattern. The amateur is always early to exit, and late to enter, or he's early to enter without the discipline to stay positioned through the preparation phase. The composite operator operates on an entirely different rhythm. He accumulates patiently, adding to his position only when he can do so without driving prices against himself. He waits, sometimes maddeningly long, for the public to become interested. Then, when his markup campaign begins, he doesn't exit at the first sign of profit. He allows the move to develop fully, taking advantage of the very impatience that causes others to chase the advance. I learned long ago that the market rewards those who can synchronize themselves with its natural phases. You cannot force the market to move on your schedule. You can only position yourself properly and wait for the market to prove you right. Patience isn't passive, it's the most active form of discipline. It means doing the hard work of analysis, taking a position based on sound principles, and then having the fortitude to let the market complete its work. Master patience, and you've mastered perhaps half of what separates the professional from the amateur. Claude is AI and can make mistakes. Please double-check responses. There is a law operating in the market as immutable as any law of physics, yet the amateur trader remains blissfully ignorant of it. This law will determine whether you profit or perish, and it is this: every effect must be preceded by an adequate cause. Let me state it plainly. Before a stock can advance significantly, before any substantial markup can occur, there must be a period of accumulation proportionate to the intended move. Before a stock can decline substantially, there must be distribution commensurate with that decline. Cause and effect. Accumulation and markup. Distribution and markdown. The relationship is mathematical, predictable, and absolutely inviolable. Yet watch what the amateur does. He sees a stock break out from a brief consolidation, perhaps only 2 or 3 weeks of sideways movement, and he rushes in, expecting a major advance. He's bought the breakout as he's been taught. He's following strength, as the popular wisdom suggests. But has he measured the cause? Has he asked whether sufficient accumulation occurred during that consolidation to fuel a sustained markup? Of course not. He doesn't even know he should ask these questions. What happens next is inevitable. The stock rallies briefly, perhaps just enough to confirm his brilliance, then stalls and reverses. Why? Because there wasn't enough cause built during accumulation to produce the effect he expected. The composite operator conducted only a minor accumulation, perhaps to facilitate a short-term campaign, nothing more. The amateur mistook this for the beginning of something major. I've spent years developing methods to measure this relationship. By studying the time spent in consolidation and the amount of volume transacted during that period, you can estimate, with remarkable accuracy, the potential extent of the subsequent move. Wide consolidations with heavy volume create significant cause. Brief consolidations with light volume create minimal cause. This is why I emphasize the importance of waiting. When you observe a stock entering consolidation after a decline, you don't simply buy because it looks cheap or because it's holding support. You watch, you measure, you count the weeks, you analyze the volume. You ask, is sufficient cause being built here to justify the effect I'm anticipating? The composite operator cannot circumvent this law. He may disguise his accumulation, but he cannot eliminate the time and volume required to absorb the available supply. If he wants to conduct a major markup campaign, the kind that produces substantial profits, he must first accumulate a substantial position. This takes time. This creates cause. Conversely, before he can unload this position, he must distribute it. Again, this requires time and volume. The larger his position, the longer his distribution phase must be. He's creating cause for the subsequent markdown. The amateur jumps into breakouts at the end of campaigns, After all the cause has been expended, after the composite operator has achieved his objective and is preparing to reverse course, he buys at distribution tops because he doesn't understand that the extended consolidation he's witnessing isn't accumulation, it's distribution. The cause being built is for a decline, not an advance. I cannot stress this enough. You must learn to identify whether you're observing accumulation or distribution, and you must measure whether adequate cause has been built for the effect you're expecting. When I see a stock consolidating for months with persistent volume, I know something significant is being prepared. When I see a brief pause after a long advance, I know the cause is insufficient for further markup. Indeed, distribution may be beginning. This understanding transforms trading from gambling into strategic positioning. You're no longer hoping for moves, you're calculating their probability based on observable cause. You're positioning yourself at the beginning of campaigns, not the end. The market reveals its intentions to those who understand cause and effect. Every consolidation is building cause for something. Your job is to determine what that something is and whether the cause is adequate to justify your participation. Learn to measure cause, and you'll stop chasing effects that have already been largely realized. You'll stop wondering why your breakouts fail. You'll understand that the market operates on laws, and those laws can be learned, applied, and profited from consistently. This is the difference between the professional and the amateur. The professional waits for adequate cause before expecting effect. The amateur chases effect and wonders why he always arrives too late. Conclusion: the choice before you. Now let me bring all of this together for you, because understanding these principles intellectually means nothing if you don't apply them with rigorous discipline. Every trap I've described today, the confirmation bias, the emotional commitment, the misreading of volume, the destructive impatience, the ignorance of cause and effect, these aren't separate problems. They're symptoms of the same fundamental error. The amateur trader approaches the market with hope, opinion, and urgency, while the composite operator approaches it with observation, objectivity, and patience. The amateur wants the market to behave a certain way. The professional watches how the market actually behaves. The amateur commits emotionally and financially before the market shows its hand. The professional waits for confirmation, no matter how long it takes. The amateur sees what he wishes to see. The professional sees what is actually there. Here's what you must understand: the composite operator isn't smarter than you. He doesn't have secret information that makes him infallible. What he has is discipline, the discipline to work methodically through accumulation before markup, the discipline to read effort versus result without bias, the discipline to wait for adequate cause before expecting effect, and most importantly, he has emotional detachment. Your losses don't hurt him. Your desperation doesn't move him. Your hope doesn't concern him. He simply follows the law of supply and demand as revealed through price and volume, and he positions himself accordingly. You can do the same, but it requires a complete transformation in how you approach these markets. Stop seeking confirmation of your beliefs and start seeking truth. Stop marrying your positions and start treating each trade as a dispassionate experiment. Stop interpreting volume as mere activity and start measuring what that activity produces. Stop demanding immediate results and start synchronizing yourself with the market's natural phases. Stop jumping into breakouts blindly and start measuring whether adequate cause has been built. These aren't suggestions, they're requirements for survival in a game where the composite operator holds every advantage except one. You can learn to think as he thinks. You can learn to read what he's doing. You can learn to position yourself with him rather than against him. The psychological traps I've outlined today will catch you again and again until you develop the discipline to avoid them. The market will keep teaching you these lessons expensively until you finally learn them. But here's the encouraging truth: these principles, once mastered, work in all markets and in all conditions. They're not tricks or tips that stop working when everyone knows them. They're laws as reliable as gravity, and they will serve you for as long as you trade. The choice is yours. You can continue operating as the amateur does, hoping, guessing, rushing, reacting emotionally, and the market will systematically transfer your capital to those who understand these principles. Or you can commit yourself to the difficult work of becoming a student of price and volume, of developing patience and objectivity, of learning to read the market's language rather than imposing your own narrative upon it. I've shown you the traps. I've explained how they work and why they're so effective. Now you must decide, will you continue to be the prey, or will you develop the skills to become the hunter? The market is waiting. It will teach you either through profits or through losses. The curriculum is the same either way, only the tuition differs. Choose wisely, study diligently, and above all, develop the patience and discipline that separates those who survive from those who don't. The tape tells the truth. Learn to read it.